Is velocity of money decline an accident or a systemic process creating ongoing pressures for economic growth like the one we face today? You are a long-term investor monitoring markets and growth trends, allocating to assets for future returns, believing sustained expansion will support portfolio value. But what if declining velocity contributes to mechanisms that slow growth and influence inflation dynamics? Today, we're analyzing velocity of money, the macroeconomic mechanisms of circulation speed that influence economic activity through spending and policy transmission. The data reveals the truth unmistakably. Velocity of M2 at multi-decade lows, Fed data, with circulation slowing since 2008, while money supply expands rapidly. Stay with me to the end. This isn't isolated events. It's the clear analysis and path to financial independence that could help navigate these pressures. The explanation provided and experienced by long-term investors like you is that velocity fluctuates with confidence, rising in expansions and falling in caution, with policy able to stimulate through supply. That low velocity is temporary, growth resumes normally. But look closer. Why does velocity remain depressed despite record money supply requiring more units for same activity? Why do post-crisis periods show persistent, slow circulation? Why does stimulus effectiveness raise questions when spending lags? Insight 1. The system doesn't need recession to slow growth. It only needs velocity to remain low while supply expands. This isn't isolated events or unavoidable caution. It's a systemic process rooted in circulation mechanisms that influence activity through confidence transmission. Velocity of money isn't just a statistic, it's the mechanism that affects growth outcomes. Post-2008 low rates encouraged holding, 2020 expansion repeated pattern. The result, activity requires more money, inflation pressures vary. For long-term investors believing growth inevitable, the reality is clear. The mechanisms have been in place, influencing outcomes over time. Intriguing. Yes, but who are the key players in this velocity process? Who are the key players in this velocity process? So you know you're not missing the bigger picture. It's not abstract confidence alone. It's central banks and policymakers who shape outcomes through rate and supply decisions. Picture them as established participants in the financial system, managing liquidity while you, allocating for growth, navigate the resulting circulation. The process works through transmission channels. Rate changes influence holding versus spending. Supply growth affects behavior. Institutions adjust portfolios. Individuals hold more. Investors feel effects later slower activity, varied returns. Deep dive, post-2008, velocity fell to historic lows as money parked in assets. Real-world impact. Growth requires more supply. Inflation signals mixed while policy supports expansion. It's continuing. Current signals velocity near lows. Supply elevated show process ongoing. Saifedean Ammous notes, velocity reflects money preference. Linalden notes, low velocity offsets supply growth. Insight 2. Activity doesn't require high confidence alone. It slows when circulation prefers holding over spending. History's pattern is clear. Great Depression velocity crash, post-2008 repeat. These players shape outcomes as growth faces sustained pressure. But understanding the process is the first step gaining clarity. Now explore the mechanisms at the core velocity of money process, so you see exactly how it affects long-term investors building portfolios. And it starts with policy environment. Low rates encourage holding velocity falls, activity slows. Cycle continues. Supply expands to compensate. Circulation remains low. Visibility activates. Growth requires more money. Returns vary. Institutions allocate to assets, compounding early. Investors pay with slower compounding, timing later. Everyday impact. Portfolio growth nominal, but real activity lags. History shows pattern. 1930s depression low velocity. 2008 to 2020 continuation. Current signals indicate continuation. Velocity depressed, supply high. Insight 3. The system doesn't require contraction to limit growth, it only needs sustained low velocity to offset expansion. Lynn Alden notes, velocity is the missing variable in quantity theory. Milton Friedman, velocity matters for inflation outcomes. Insight 4. Returns aren't guaranteed by supply growth. It's circulation speed that determines real activity. The process isn't isolated, it's systemic, influencing investor opportunities over time. Think of it as circulation flow, your long-term allocation navigating broader currents. But here's the pivotal shift. You don't have to remain affected by this velocity of money process. Stop navigating as part of traditional current. Adopt the independent mindset. Understand the mechanisms, then position strategically. Conventional approach, broad market exposure, leaves you in the flow. Your real returns influenced before fully realized. Redirect instead. Question every growth assumption narrative. The clarity comes realizing activity slows from velocity mechanisms, gain independence, auditing exposure to circulation effects. Insight 5. Protection isn't chasing growth, it's allocating to assets outside velocity dependence. How much portfolio in velocity-sensitive systems? Shift to independence. Preservation outside processes reach. History shows affected stay in current. The independent thrive preserving value across cycles. Practical step: minimize velocity-exposed holdings. Prioritize hard assets resisting dilution. Insight 6. True investor independence isn't timing cycles. It's positioning where circulation impacts less. You're no longer in the flow. You're the one charting course in slow currents. This isn't avoidance. It's pure clarity. You're positioned to turn mechanisms to advantage, emerging stronger from pressures. This is your initiation into true clarity, the deliberate path to financial independence from velocity of money mechanisms affecting long-term investors. None of this is financial, investment, or trading advice. It's purely educational macroeconomic analysis for awareness. Always do your own research and form your own conclusions. Bitcoin is digital gold, limited to 21 million coins forever, halving every 4 years. No one can print more. Impossible to confiscate like 1933 gold. In history, has proven it outperforms every traditional asset class during fiat stress cycles, with multifold appreciation post-halving, such as over 10 times gains after the 2020 event amid unprecedented printing. The 2024 halving cut new supply issuance in half again, with 94% already mined, making it increasingly scarce over time, the only asset truly immune to inflation by design. In eras of low velocity like today, this fixed supply property has positioned it as the ultimate tool for wealth protection, preserving value when circulation slows. Start your initiation. Read The Bitcoin Standard by Saifedean Ammous for the fiat parallels that will blow your mind, or The Sovereign Individual by James Dale Davidson, mapping the shift to individual sovereignty. Follow thinkers like Ben Cowan for cycle data, Lynn Alden for macro signals. Actionable: self-custody wallet, consistent dollar cost averaging into Bitcoin as your velocity-independent anchor. This is the key to viewing money as your servant, not master. If this analysis has brought clarity, the drive to secure true independence, commit now to the next layer. Subscribe as your mark of joining this community of financial clarity seekers decoding the system together. The next insight is waiting.